In this video, we're going on a detailed overview on how I analyze companies here on GrowthShares. My analysis videos look solely at the long-term prospects of a company. The only viable strategy that will work based on these analysis videos are the simple buy and hold strategy. First, the companies are in different sectors, and because of that, it wouldn't make sense to compare a company from one sector to a company in another sector. So to remedy that, the data and corresponding grades account for the sectors the company is in and adjusted so that we can compare companies between sectors. Second, the analysis is divided into three factors: the business, the stock, and the price. The business looks at the company's business and fundamentals to see if it's doing well in its field. The business factor makes up the largest portion of the analysis at 45%. The stock factor looks at the company's stock price and how investors, traders, and other analysts see the company from a technical point of view. This factor accounts for 35% of the overall analysis. Then there's the price factor, which looks at the intrinsic value or fair value price of the stock. It basically tells us at what price is the best price to buy the company's stock. This factor accounts for the smallest share at 20% of the analysis. Once we figure out these three factors, we add them together based on their weighted importance to get our company's final grade. But then how do we figure out each of these factors in the first place? Each factor has a number of metrics that in part make up each factor. In total, there are 14 metrics that are again weighted according to their importance. These 8 metrics make up the business factor. These 5 metrics make up the stock factor. And intrinsic value makes up the price factor. Each metric and the 3 factors are graded on a 1 to 100 grade scale, with a grade of 1 to 10 being considered a failure, 51 to 60 being considered average, and 91 to 100 being considered extraordinary. As such, most companies I analyze will fall in that 51 to 60 average range because most companies are indeed average long-term investments. Now, I'm going to go through each of the 14 metrics and what they mean to the entire analysis. Remember, these are the 8 metrics that make up the business factor, along with their weight to that factor. Growth looks at the projected earnings growth of a company over a number of years. Basically, we want the company to grow a lot. A growth rate of negative 15% or lower will give us a score of 1. A growth rate of 15% will give us the average of 51, and a growth rate of 44.4% or higher will give us a grade of 100. Margins looks at the output generated for every dollar of revenue created using various financial margins to get that calculation. Margins of negative 20% or lower give us a grade of 1. Margins of 10 gives us the average of 51, and 39.4% or higher gives us a grade of 100. Operations looks at how effectively a company is running its business using various financial ratios to get that calculation. A ratio of 25 or higher gives us a grade of 1, a ratio of 12.5 gives us the average of 51, and a ratio of 0.25 or lower gives us a grade of 100. Debt utilization looks at how much debt is being used to fuel a company's growth using various short and long-term debt ratios to get that calculation. A ratio of negative 2.5 or higher gives us a grade of 1. A ratio of 0.75 gives us the average of 51, and a ratio of 3.935 or higher gives us a grade of 100. Efficiency looks at how well a company is using invested and reinvested capital to run its business using various financial returns to get that calculation. An efficiency of negative 20% or lower gives us a grade of 1. 10% gives us the average of 51, and an efficiency of 39.4 or higher gives us a grade of 100. Employee growth looks at whether a company is hiring at a rate equal to or higher than the country's GDP growth. This shows a company is committed to a positive societal output. A growth of negative 20% or lower gives us a grade of 1. 5% gives us the average of 51, and 29.5 or higher gives us a grade of 100. Sustainability looks at a company's ESG risk rating, which measures a company's environmental, social, and governance impact. A rating of 40 or higher gives us a grade of 1. A rating of 20 gives us the average of 51, and 0.4 or lower gives us a grade of 100. And then there's market dominance, which looks at how close a company is to having a monopoly power using various data such as primary product market share and so forth to get that calculation. A dominance of 100 or lower gives us a grade of 1. Dominance of 50 gives us the average of 51, and dominance of 1 gives us a grade of 100. Next, we're going to go over the 5 metrics that make up the stock factor. Stock performance looks at the short and long-term stock performance of a company when compared to others in its sector and to the S&P 500. A performance of negative 30% or lower gives us a grade of 1, 0% gives us the average of 51, and 29.4% or higher gives us a grade of 100. Dividends looks at how much a company pays its shareholders based on the dividend yield. The higher, the better for long-term investors. A yield of 0% gives us a grade of 1, a yield of 1.75% gives us the average of 51, and a yield of 3.47 or higher gives us a grade of 100. Technical analysis looks at a stock's technicals using RSIs and moving averages as its calculation. 35% or higher gives us a grade of 1, negative 7.5% gives us the average of 51, and negative 49.15% or lower gives us a grade of 100. Wall Street analysis looks at what Wall Street analysts think of the company because other opinions do sway the direction of a company based on their calculations. A ratio of 5.039 gives us a grade of 1, a ratio of 2.99 gives us the average of 51, and a ratio of 1 gives us a grade of 100. And short interest looks at the sentiment of traders and investors through how much of a company's stock is being shorted. The more a company is being shorted, the worse off it is. A short of 25% or higher gives us a grade of 1. A short of 12.5% gives us the average of 51, and a short of 0.25% or lower gives us a grade of 100. Finally, we look at the only metric for the price factor, the intrinsic value. The intrinsic value, otherwise known as a company's fair value price, is calculated using a discounted cash flow model to determine the true price of a company. A value of negative 42.5% or lower gives us a grade of 1, and a title of expensive. A value of 0% gives us the average of 51, which makes the stock fairly valued, and a value of 41.65% or higher gives us a grade of 100, which means the stock is a bargain. The values and grades are determined using data and backtesting algorithms in order to optimize the values to correspond with the grades they are given. I'm a big believer in letting data drive the narrative, and almost all financial information is built into a company's publicly available data. Wherever the data goes, I'll follow. Remember, my analysis videos are meant for the long term. And otherwise noted, any drastic changes to the company to surrounding events may change the grades, and if that happens, I'll be sure to update the grades for those affected companies. So once each of the 14 metrics are calculated, we give a grade for each of the 3 factors. We add those factors together and we have our company's final grade. I put the most importance on the business because as a long-term investment, you're investing in a company and how well it will do in the future. The stock and its price are important, but if you have to pay attention to only one factor above all else, it's the business. So before you check out my other videos, consider becoming a Patreon member for only $2 per month. As a patron on GrowthShares, you'll receive a spreadsheet with the business, stock, price, and final grades for every company I've analyzed. It's updated all the time with new grades and more companies. Go to patreon.com/GrowthShares or click on the link in the description below. And now that you know what each of these metrics and factors mean, you can check out some of these videos. And as always, take care of your money.